Hey guys, in today's video, I'm going to take you through 4 high quality ETFs to buy and hold forever. Okay guys, let's get into the video. So before we get into the actual content, please read this disclaimer. This is not financial advice. If you need financial advice, please seek out a professional. Okay, let's get into my first pick. So guys, I'm going to first outline my ETF strategy, and it's something very simple that any beginner can follow along with. Okay, so my strategy is you choose 2 to 6 of your favorite ETFs. Okay, so ETFs can be bought on the ASX just like any old stock. So choose 2 to 6 of them. Make sure you look at liquidity. So do the shares trade constantly, and the size. So these 2 things are important, because if the ETF is too small and not liquid, meaning that the shares don't trade often, it could mean that you're not able to buy or you're not able to sell when you need to. And the size, normally the bigger the ETF, the lower the fees, and fees are another thing further down here. So past returns, you should look at the track record. So what sort of returns have these things done in the past and for how long? Look at the companies they're made up of, because this is going to determine the future of the ETF. Because obviously if the ETF does not have good companies in there, then you cannot expect to get good returns from this. Okay, so the next one is fees. So obviously the lower the fees, the better. And then slippage and spread. So that's the buy and sell spread there. And obviously the bigger the spread, the worse, because it means that you're going to be paying more for it. Choose a broker with low or no fees. So at the moment I've been using Superhero, which has free trades on ETFs, which is awesome for beginners. So you're not going to be paying any fees on your trades, and that means you can slowly build this up over time. And so number 4 is put money aside and buy on a monthly, quarterly or 6 monthly basis, or as often as you want. Especially with these free trades, you can just continuously buy this, and you're going to be able to build a nice size portfolio over time through your savings. So the other point I'd make here is, if there's a big market drop, make sure that you buy an additional amount, because you're going to be dollar cost averaging at a time where the market has dropped. And because these ETFs track indexes, during big drops, it's a perfect time to buy them. And then sit back and reap the rewards in 10 plus years, guys. This strategy, if you keep doing this, what I show here, and if you buy the ETFs I show you in the next section, you are going to have a much bigger and much more, you're going to have 1, a diversified portfolio, and 2, one that's, I guess, less risky than buying individual shares. And also, obviously, because of the low fees or no fees with some of these, or no trading fees, you're going to be able to amass a nice amount of wealth over the long term, and this is a nice, easy, passive way for you to build a portfolio. So the first one is the Betashares Nasdaq 100, ASX ticker NDQ. Okay, so I'm going to take you firstly into the fact sheet, and then I'm going to take you through my investment thesis for buying this. Okay, so the Betashares NDQ, this ETF, as you can see, has had a really good run, especially recently. So the 1 year performance is 35%, which is absolutely amazing, guys. And then since inception, which is only since May 15, it's 21% annualized. So this is a really high performing ETF. It pays a good dividend yield of 2.6%. It has relatively low management fees of 0.38%, guys, and the expenses of 1.1%. So obviously it doesn't have a really long track record, but Betashares is known for producing good quality products, so there's not really a fear there, and it's also quite a large ETF. So obviously this is trying to mirror the Nasdaq 100 index in America. So it's a big ETF, guys. It's got a $12,812 billion market cap, so it is really big. Obviously its PE is a little bit expensive, but the reason for this, guys, is if you have a look, it's really tech heavy. So almost 50% of this comes from just these handful of companies here, being Apple, Microsoft, Amazon, Facebook, and Alphabet. Okay, so most of them, obviously, you're getting exposure here to some of the best companies in the world. So now that we've covered off the I guess the financials of this, I'm going to take you through my investment thesis for buying NDQ. So guys, most of the growth in the stock market is coming from technology, and so if you get access to this through NDQ, you're going to be getting access to some of, well, the biggest, most innovating innovative tech companies in the world. And so obviously if share prices go up from growth, so you want to take part in that growth. The easiest way to do this is through the NDQ. It's ETF. It's highly diversified, and it's got some of those amazing companies in there. The other great reason to buy this, guys, is US exposure for Aussies with no headaches. So you don't need to buy US dollars. You don't need to select individual US stocks that you may not be able to find information on. You don't need to fill out tax forms. This is an Australian domiciled ETF. So none of these, you will not have any of these issues were you to buy individual stocks. So the other good thing is a lot of you are going to be familiar with these companies. So you will know that, how big Google, Facebook, and Apple are. So you know what companies are in there. You know that they're successful. COVID has been a massive tailwind for a lot of these tech companies, so they've been given an even bigger boost because of this. And the other thing is this ETF has a great historical track record, and as does Betashares. So, over time, start putting some money into this ETF. Although it is a little bit expensive at the moment, if you have a nice long time horizon, it's still a good time to buy. And even more importantly, if you do see a big drop, then buy some more of this ETF. So moving on to the next ETF, it's the Vanguard Australian Shares Index, ASX ticker symbol VAS. Now this is where we're going to get our Australian share exposure. So obviously we're Australian investors. We do want some exposure to home companies, okay? So I'm just going to take you through the ETF fact sheet. The reason I really like this, guys, is it only has a 0.1% per annum expenses management fee, which is really, really low. So obviously the lower the fees, the better. This is about as low as it gets. It's also a really, really big ETF. So it's $18.8 billion in size. So it is a big fund. So the ETF size is 6 billion and the total fund size is 18.8 billion. Okay. It's super low cost, guys. It gives you some really broad exposure. So it gives you exposure to the ASX 300 index, which obviously contains 300 of the biggest companies in Australia. So it actually has 302 companies. It's got a decent track record as well, guys, and it's been around for well over 20 years, nearly 30 years. So just under, I believe, 23 years it's been around for, and it's given returns of 8.28% returns, which is really, really good. It also pays a nice little dividend as well, given that it is an ASX listed company. So just to take you through some of the holdings, we've got CSL, Commonwealth Bank, BHP. So obviously a lot of the banks, Macquarie and Transurban. And obviously the PE is a lot lower than the NDQ. So it's 10 multiples lower. So it's 19.7 and a really conservative, obviously, price to book of 1.9. So not too high, given it's mainly made up of banks. Okay, so earnings growth rate is also a little bit lower at 7.9, but the dividend yield is much higher at 3.6. So you're going to get a nice little dividend yield here as well. And as you can see, the reason I like buying these guys is look how diversified it is. You've got financials, materials, healthcare. You've got tons of different sectors there. So really good exposure. You're not going to have to go and look for individual stocks. So my broad investment thesis, guys, is main reason is the really low management fees, 0.1%. So on $1,000, you're just going to pay $1 per year, and it's got a really good track record of lowering these fees. I don't know if it's going to get any lower, but this ETF has consistently lowered their fees. Arguably the best ETF to get exposure to the ASX, so it's probably the lowest fee, it's the largest, it's the most liquid, pays a really good dividend, and it's been around since 1997. As I said, highly liquid, easy to buy and sell, and Vanguard is one of the biggest and best fund managers out there. So definitely worth adding to your watch list and building exposure to over time. So guys, the next ETF is the Vanguard Emerging Markets Shares ETF, so VGE. I'll take you through the fact sheet right now. Okay, so the Vanguard FTSE Emerging Markets Shares ETF seeks to track the return of the FTSE Emerging Markets All Cap China A Inclusion Index with net dividends invested in Australian dollars. So that's awesome because obviously we don't want to buy tons of different currencies. This gives us exposure to all these different countries in the emerging markets. And without even having to exchange any actual different currencies, which is awesome. So it's low cost as well at 0.48% per annum, which although might sound a lot more expensive than VAS, normally emerging markets shares ETFs are more expensive because there's more fees involved and obviously a lot more work for the fund manager. It's got a good little track record as well at 7.53%. And guys, obviously the ETF isn't as big as the other one, but it's very well diversified with well over 5,000 holdings right now, which is huge. And so you're getting holdings to companies all over the world, which I'll take you through right now. Okay, so look at this. The PE ratio is much smaller. The median market cap is also a little bit smaller as well. So it's got a PE of 16.6. Book price to book is about the same as Australia. Much higher return on equity and growth rates though, guys. A little bit lower dividend than Australia, and you can see why. All of these countries here, so we've got China, Taiwan, India, Brazil, Indonesia, Philippines, Qatar, lots of different countries here. All of these countries are in their growth phase, and that's why you're seeing higher returns on equity and higher growth rates. So I think it's very smart to get some exposure to some emerging markets. So you're getting access to companies here that you wouldn't get access to in Australia. In some countries where they're seeing much bigger growth faster than Australia because they're a developing country. So you get exposure to some really cool companies too, Alibaba, Tencent. So it's not just small companies, it's some really big ones too. Taiwan Semiconductor, Naspers, which is a South African company that is really, it's almost like the Berkshire Hathaway of South Africa. JD, China Construction Bank, Ping An Insurance, Infosys, lots of big companies there, guys. So although it's an emerging market ETF, it is made up of a lot of big companies as well. So some of these countries here obviously only make up a really small portion, like Saudi Arabia, Hungary, Colombia, all of these. It is mainly a China, Taiwan, India, Brazil ETF, but you are getting some exposure to some of these more, I guess, developing countries. So I'll take you through my market thesis on the stock right now. So it's unique exposure, guys, to 21 of the world's emerging economies in Asia, Latin America, Europe, Africa, and the Middle East, and allows you to diversify away from Australia and the USA. So obviously, if we play too much within Australia and the USA, if something unique to those countries happens, then we're going to get hit. And there's huge amounts of growth coming from these countries, which you obviously want to get exposure to. Extremely well diversified. I've got 3,500 shares here. Obviously, it's a lot more now, so it's 5,000 according to the fact sheet. It includes Alibaba, Tencent, and Naspers, which are really cool big companies, again, within tech. It's Australia domiciled, which simplifies tax admin, guys, so you're not going to have all those tax and administrative headaches, and it's really low cost exposure for an emerging markets ETF. This is definitely one I recommend you get some exposure to. Okay, so the final one is the Perth Mint Gold ETF. I believe everyone should have at least 2 to 5% of their portfolio within gold, and this is a nice way to get access to actual physical gold without the need to store it. So let's get into the fact sheet from the Perth Mint. Okay, so PMGOLD is designed to track the international price of gold in Australian dollars and offers investors a simple, low-cost way to access returns on gold. So gold has been very much in favor of late, and there's a nice, cheap way to get access to it with a 0.15% management fee. It is a decent size ETF at 614 million, and as you can see, it's been doing really well all the way from 2003, but especially in 2019, 2020. It's gone really well, guys. As you can see, in the last year, almost 20% returns. Over the last 3, 17.65. Over 15, it's 10.25, and since inception, 9.5%. So it actually outperforms the ASX 300 ETFs. So obviously, you're not getting the dividends on this one, but definitely worth having some exposure to some actual metals as well, because these tend to be a hedge against inflation and a hedge against a currency devaluing. With all the additional printing that's going on, I definitely recommend having some exposure to this, and potentially even some exposure to some Bitcoin. So let me get into my investment thesis for this product. So, you gain exposure to physical gold through an ETF. You're not actually going to have to hold this at home or in the bank. You don't have to go to a shop and buy it and then worry about it being held somewhere, having a safe and all those things. This is going to sit in the Perth Mint. You get an allocation. It tracks gold in AUD, so it actually protects your Australian dollars against changes in the currency as well. So if the currency drops, right, then your actual investment may go up depending on what happens. So low fees, so 0.15%. So that's really low fees. Imagine if you had to pay someone to store it, it would be much higher. It's physically redeemable. So if you wanted to, you could turn up to the Perth Mint and redeem your ETF in actual real gold. and it's government guaranteed, highly liquid, and it's got a really good track record and performance. So guys, I think this is a must. Obviously don't put too much of your portfolio, but you want some exposure to this ETF and just slowly buy it, once a year, once every 6 months kind of a thing. So guys, I hope this video has helped give you some ideas to start your investing journey. ETFs are a really good way to get started, especially if you use something like Superhero, where you're going to get free ETFs trades. So yeah, happy investing guys, and see you in the next video.